Hey Shane, how's it going?
I'm pretty annoyed, man. I'm pretty annoyed today. And like basically so far this year, market's confounding lots of people who think they're smart like myself. So I don't know. I think you gotta check your intelligence at the door and just buy stocks.
Yeah, you could certainly think that. I know didn't expect January to start off like this, and yeah, it's confounding to say the least. Technicals are telling us one story, and fundamentals are telling us a different one.
Well, it was the best January since 2001. So we'll get to a chart talking about that a little bit later, but many of you, well, some of you out there might know how that ended up in 2001. But we'll show you. We'll quantify it a little bit. We'll do the math, and we'll see. Maybe what's in store for us right around the corner. What could possibly go wrong? Well, Nasdaq was up like 10% in January, and the profitless growth basket from Goldman Sachs was up like 22% in January. Um, so yeah, we'll see how that has historically worked out. And I don't know. I think maybe you just need to be patient. Like I said, either check your intelligence at the door and just buy stocks, or be very patient and wait for things to kind of come back to reality. Because like we said before, the economy is it's the economy and the market are like a guy walking his dog, right? They're both ultimately going from they start at the same place, they end at the same place, but they take very different paths to get there. But the dog is anchored by the man, and in this case, the economy is the man, and the stock market is the dog.
Yep,
So anyway, we'll go through some charts and some data and try and keep it short and sweet for the most part because I think we're all busy after being out of the office last week. So
that we
looking
are.
forward
So
to the chat, my friend.
I am as well. So today's February 2nd for anyone tuning in, and please like, subscribe, throw some comments in there. Just if you want us to cover stocks or any topics, happy to do so. So I'll go ahead and turn it over to the charts.
Cool.
All right, so we'll get into it, and as always, let's start with the SPX. This is one. So we had the downtrending resistance line. That's the first thing we were really looking at. We had the 200-day moving average. That was the other one. And here we are, kind of consolidated above it, headed higher. And I think one thing always to just keep in mind is trend lines. They're good, you know, sources to tell us where things might be headed. But ultimately, I think the test is going to come up to this last high that it doesn't quite show on this spot here that happened back in December. But, we had an overnight run up. I think that was when CPI came out. And if we can get above that, that's right at 4,200. That starts to make me wonder a little bit, but it's it's confounding to say the least. The technical picture is much different right now in the major indexes than the fundamental story. So, Shane, what are your thoughts there?
I mean, it's hard to argue with how bullish that looks on a technical basis. I mean, that's a long series of lower highs that just got demolished. We broke above the last high from December, and I mean, it's hard to argue with how bullish that looks. It makes me sick to my stomach to think that it's that bullish when the fundamental economics behind it are so awful. Um, but here we are. So I'm glad that when we're bearish, we don't like go 100% cash. We still, hold some longs, and my personal account is long. Makes me sick to my stomach to look at the longs in my account. I don't like any of them, but you trade the market you have, not the market you want. And it's not that I want the market to go down and for people to lose money, but I, I, I don't know. When I like it when prices align with reality in the economy. That's like
Hmm.
it's just something I prefer. Do I wish the market could go up all the time? I guess so. But there are times to sell. Like last year was a time to sell every single rally. Now we've got a series of, well, we've got at least one higher low, right? And now we've
Yeah,
got a higher high. And so, I mean, bottoming is a process, not an event. And maybe we're starting that process despite the fact that we're probably heading into a gnarly recession. So yeah, I don't know, man. It looks bullish. I hate to admit it, but if you had no other information, you'd be buying the crap out of this. There's just
Yeah.
no way, there's no two ways about it. You'd have to buy. And I think that's what we're seeing happen in the markets. I think a lot of portfolio managers are afraid of getting left in the dust. And so they're just buying and they'll buy now and ask questions later. And when they start getting the answers to those questions, my guess is we're gonna see a drop. You were saying right before we jumped on. What were you? How did you say that? I think you put that pretty well.
Yeah. So the big thing when you have markets like this is one, Paul Tudor Jones has said it, that to really make money in the markets, you have to be a contrarian. But right now, I go around, I talk to people, and they're still bearish. We're bearish. And you really need to hit that pain point where all the shorts just give up. And it finally then you get that big washout. And you don't know what that event it will be that does it. You know, events that are broadcast typically do not do it. It's events that come out of nowhere. Take COVID, for example. Everybody knew the market seemed overvalued and we were due for a correction, but nobody was out there saying, well, there's going to be a disease that comes out and does it. And that's what we're looking at here. I mean, technically it's bullish, but the fundamentals aren't agreeing with that. And what's probably going to set this off is when it's not obvious. So when you get up here and it pushes bears out and everybody then switches and goes, market's going higher, I want to buy everything. Something likely could happen in there. And that's when you get that big, push lower that really hurts. It doesn't mean it's going to happen, but that's typically how it has played out in the past. When you get that big washout is when you finally get everybody to the other side of the trade.
Hmm.
So
Yep.
we'll see here. I think, for me, when I'm trading my own personal account right now, I'm trying to stay away from the index because it's not the prettiest chart I've seen. There's ones out there. Just, Nvidia, Netflix, surprisingly enough, is looking a little better. Square, these simple stocks that they're trending up and it's a little easier. It doesn't mean they're great companies. They could all go to zero, who knows? But if you can find the leaders in this market and ones that are just trending nicely, it's probably a safe place to put some money. Hershey too. We talk about that one. People, they're not going to stop buying candy bars. So there are names out there that I think this is where it becomes more of a stock pickers market rather than just focusing on the index.
Yeah. Hershey had earnings yesterday too, and it's up 2% here today.
Good to
Two and
hear.
a
So
half, 2.5. Yep. Anyway,
and
yeah,
then
it looks bullish, and again, and I hate it. So yeah, the SPY is what we got here, and looks the same, obviously. But if you look at, there's a couple extra lines on this one, and we'll probably throw out that SPX chart and just focus on the SPY going forward because you guys can actually trade this, just buy the ETF. But we are running into some resistance here, going back to June of last year. This is where the rally failed then. Um, and if you go back even further, this was a low back in 2021. Um, so this resistance line, this orange line that you see at like 415, is a relevant spot. You can see like even back in March, it represented some support, and then in June it represented resistance. And going back to the left of of where the chart ends, and you can't see, there was other support there too. So this is an interesting level. And I again, like, we're getting into overbought territory. We're going up on bad news. Fed's hiking rates and profits are lower. I don't get it. I don't get it. So I'm looking for a place to short, but for right now, the chart is going higher.
yeah. And one thing I wanted to mention, this is a perfect example of why it is so hard to go 100% cash when you think the market's going lower.
Yep.
Because now you get this rally, and if you don't have anything invested, now you're going, oh shoot, am I missing it? And you're going to probably make an emotional decision and buy, right up here, right before it falls over, or up in here. Versus, if you stay 50% invested, you're catching part of this. It's okay, and you can patiently wait for a good entry.
Yep.
So Shane, you brought this one up. This is the NDX back in 2001. Uh, January similar to this one in a way, very bullish, and then looks like the year turned out a little different.
Man, yeah, this wasn't the order I wanted for this, but that's all right. No big deal. We'll get to QQQ here in a second. But yeah, as I mentioned earlier, we just came off the best January since 2001, and I mean, you can see what happened. Market was down 67% over the next what is that, 600 days? So it took, is that right? Yeah, took almost 2 years for the market to put in a low after that. And the market was already down. You can see coming into that January period, the market was already falling from over 4,000. I mean, it was even higher than that. I don't have the whole chart there, but I'm gonna go look real quick. How much was the market down into that January of 2021 event? It was a lot because it wasn't the Nasdaq, like, yeah, it was 4,800. So coming into that event, it had already dropped 43% over the course of 300 days, and then took another nosedive for the next several months, almost 2 years. So, I mean, history isn't going to repeat exactly, but it often rhymes, and we'll see what happens. But the Nasdaq was up a lot in January, like I said, over 10%, and it might just turn around and start falling from here. So, just because we had a good January doesn't necessarily mean we're out of the woods yet. And hey, by the way, Kyle, I learned something this week that I never knew before. You know how we always talk about how much you need to make in order to get back to even after a loss?
Yep.
So I learned a little trick. Like for example, if the let's say something was down 67%, right? How much do you need to get back to even? So if you take 100 minus 67, you get 33, right?
Hmm.
So just use 100 as your base and then subtract how much are you down from 100, right? And you'll get the number. Whatever number you get, in this case 33, you take 67 divided by 33 and you get 2.03. That means you need to be up 203% to get back to even. I never knew that trick. Same thing, like if you're down 80%, right? Well, that means the what you divide by is 20 to get back to 100, right? So
Hmm.
80 divided by 20 is 4. So that's 400% that you need to get back to even. Never knew that trick. Learned that this
Interesting.
week. Yeah, pretty quick. So a bar trick or something if you're out with your friends and you want to show them how smart you are. You just use 100 as the base and subtract whatever you're down, and then divide however much you're down by that number. So again, 67 divided by 33 is just a little over 200% to get back to even.
Pretty clever.
Yeah, math, bunch of nerds.
Yep.
Anyway,
So,
here's the QQQ. Also, just looks stupid bullish.
yep.
Almost back to where we closed the year 2020. So, um, so far the 2021 gains for QQQ have been totally erased and haven't started clawing back yet. Um, and let's see, where are we at? So even today, after this monster rally from the high, the Nasdaq is still down 24%. So
Interesting. So,
still down 24%. No big
yep.
deal.
But yeah,
Um,
I don't know. That's a bullish chart. If we only look at technicals right now, it's starting to make me think we're headed higher, but we'll wait and see on that one.
yeah, it's bullish. I don't know. Disgustingly bullish.
Yep. And then Shane, here you've got the chart of oil, and I'll disclose I am long oil here, just on a short time frame. This chart doesn't look great. You've got this uptrending support line right here under it. We'll see if today can hold the 76 level, but it's so shocking. And this, I just want to highlight this. This is what happens when people get convinced of a narrative. Last year, all you heard, oil going to 200 or some astronomical number. Fundamentals seem to align. Chart told a very different story and continues to do so. So always keep that in mind when you hear the headline saying one thing, doesn't necessarily mean that's what the market will do.
Yeah.
So
And by the way, we've got sorry, going back to the NASDAQ just real quick. We've got, I think, Apple, Google, and Amazon all report tonight. Uh, so if those companies all were to miss expectations or report poor guidance or something like that, um, you know, the Nasdaq could like open at 290 tomorrow. I mean, they could also report really good numbers. Meta came out, Facebook came out and reported some good numbers yesterday, and it went up 20%. So that's kind of why we're seeing a nice big rally today. I think a lot less so because of the Fed hiking rates yesterday, which of course is not bullish. It's not dovish. It's hawkish and bearish, if anything. Um, so, again, profitless tech companies that need to borrow in order to make money or need to in order to finance their growth, they all have to pay more to borrow that money now than they did last year. There's no reason for them to be getting a bounce other than the fact that lots of them are down 80%,
yeah,
right? And as we know, if you're up 20% after being down 80%, it's really you're not even close to getting back to even because if you're down 80, you need to get 400% to get back to even. So a 22% gain is not going to get the job done. You got a long ways to go.
yep,
So anyway, tonight's a big night for earnings, and I think earnings are going to be mostly a disappointment. So I don't know, maybe I'll be wrong again, but strap in. Should be an
yeah.
exciting ride.
It'll be interesting. I definitely, short-term trading here. I can't say I'd want to be long off this large rally we've seen into a report like that. Might be a good time to just de-risk a little bit, but yeah, that's something else. I forget the
And
statistic. They report they're I think 15 or so percent of the entire index. So
yeah,
it's pretty
Amazon and Google are both up 6% into earnings tonight. Think about like to me that's something I would like almost automatically short.
yeah.
Just cause like that shouldn't happen.
Hmm. Yeah,
Shouldn't happen. That's people acting like they know what's coming, and then oftentimes the market will surprise people. So like I'm surprised right now.
yeah, you and me both. So, but yeah, oil, nothing too big there. This is the biggest one. We keep highlighting this. This is the inversion of the yield curve, and it is still at record lows. This is the best recession indicator, and it still looks absolutely terrible.
Yeah,
So,
I can't. I don't know. Powell yesterday seemed optimistic that we would not have a recession. Um, but he also said that's probably not the most likely scenario. So, I mean, he's not an idiot. They're going to keep hiking rates. They said ongoing rate hikes. So I think they're going to continue hiking, and I don't know. It all just points to a massive recession, which means to me, the more people that get their money in ahead of this train wreck that's coming, the more they're going to lose when the train finally wrecks. And
yep,
so that's kind of what I see coming. And the question is can you stay patient? Because like right now, I keep telling you like how frustrated and annoyed I am. And, here's what'll happen is the moment that I say, all right, I have to buy. I'm going to put my whole money, my whole stack long the market. That's exactly when it will crash.
yeah,
So the idea here is to be patient, be still, don't get caught up in the FOMO and all these other crazy things and the bullish pivot narratives and all this. Just it's all nonsense, right? Like we see the reality. We see what's going on underneath the surface. Um, and it sucks because we have our head underwater, you know, seeing what's under the surface, and everybody above the water is partying and have a good time, but underneath it's like, pretty scary.
yeah.
And you just need to be super patient and let it play out and not do anything crazy.
And a big thing too to drill home is that right now, so Shane, you mentioned you've got all the or long positions in your personal account. You can definitely do that. You can make some good trades right now, but you have a trailing stop. So that is a predefined exit where when that thing breaks trend, you get out. So you can capture a little bit of return doing that, but blindly hopping in right now thinking this is the long-term bet and having no risk management, it's a pretty dangerous game to play.
Yep, agreed.
And then Here's the dollar. It's funny we get this green bar today because I don't know if you saw gold, but gold made a nice turnaround. I think it hit 1950 and then, uh, or actually 1970 last night and then sold off. This is probably the culprit. It came back down into that 1930 range. So yeah, dollar's still getting a little weaker, which could be good for the equities. Kind of hard to predict that right now. You've got the support right there at right around 100, and 100 is also a nice round number that sticks in people's minds.
I think it's interesting that the dollar's up that much today. When yesterday the Fed hiked by 25 and today the ECB hiked by 50 basis points. So
Hmm.
the dollar should go down when the ECB hikes by more than the Fed. Like when interest rates go up faster in Europe than they do in the US, that should actually uh, lead to a lower dollar and a higher euro, respectively. So I don't know what's driving that today. It's not what I would expect, but as I've said this entire call, none of what's going on in the markets right now is what I would expect. And so that that if nothing else, that's a reason for caution.
Yeah. And then here's mortgages. So, it's encouraging now if you want a 15-year, you can get those for right around 5%, and a 30 years at 6, which historically I think five's not that bad of a number. So we're in there. It's pulled back a little bit. We were up at 7.
Yeah, still hanging above 6 though. That's impressive, and that's much higher than it has been for the past several years. I think it's probably about the average since the 80s. 7 was a lot to handle for a lot of people, but 6 is materially better, and I wonder how long it'll stay that way.
Hmm.
Again, Fed's still hiking, so look out for those rates to continue kind of climbing higher over time. But I don't know. I feel like most of the increase in the short run, we've seen it. I think most of that's behind us.
Yep. And then Shane, turn into this one. I love this tool. So barchart.com has this, but this is the S&P 500. Every sector within there, across the top, you have the different moving averages, and then it tells you what percentage of that sector are above that average. And, I was telling you earlier, and I've mentioned this in the call before, but when it gets difficult to play the index, you don't have to play that game. You can come in here and oddly enough, I thought this just surprised me, and I don't have an explanation. 87% of financial companies are above their 200-day. You would think with the inverted yield curve, they're doing the worst. But
Yet another thing that makes no sense.
yeah, so that's contradicting. But what does make a little more sense, I guess, is that, you've got consumer discretionary, which, you know, if we are in a bull market, makes sense that would be up a little bit. Information technology, so tech, and then materials, and then you see utilities coming off. That's interest rates going up, and people maybe taking a little more risk on. But the big thing here is just go play in these sectors that are doing well, and you'll probably find some stuff that's trending up, and you can usually find a few good names there. You want to own the leaders of the market. So just a nice place to look for kind of if you're trying to build a portfolio. I always like to start here.
Yeah, own them for as long as they're leaders. I don't understand, again, like how is it possible that, like, honestly, discretionary and tech are the things that were like down the most last year, so it's no
Yeah.
surprise that they're off to the best start. But I think that I still kind of think that's probably just a bounce. I mean, um, everything behind, like everything behind a discretionary stock is like it's not stuff you need, it's stuff you want, right? And the
Hmm.
American consumer is tapped out. They're saving less than they've ever saved before. Their credit card balances are higher than they've ever been before. More people are carrying a balance than have ever carried a credit card balance before. The interest rate they're paying on that credit card balance is higher than it's ever been before. People making over $100,000 are living paycheck to paycheck at a higher rate than ever before, and yet consumer discretionary, the wants, those stocks are going up the most.
Yeah.
It doesn't make any fundamental sense at all, and it's probably a selling opportunity. Now, again, like you said, for as long as it is going up, as long as you want to ride that trend in a shorter term trading account, that's what you do, but have your stops, know what your exit is. It's always all about risk management, as we talked about a lot. Um, so none of that makes any sense, but that's the world we're in right now.
Yep. And I will tell you, if trading the markets, if it made sense to everybody, people wouldn't be making the kind of money they do.
Yep.
So it's those that are able to set their bias aside, listen to what the market's kind of showing you and trade upon that. And yeah, we talk about it all the time, but I think my win rate's maybe 50%. But if you manage the downside, you can perform really well. But you know, I pulled just a couple headlines, but here's the, European Central Bank hikes rates. Here's yesterday's Powell. And of course, this is the one, oh, the markets hear it differently.
Dude,
And
you watching his press conference yesterday was absolutely hilarious. He like every time somebody asked him about cutting rates or pausing rate hikes, he literally just shook his head at them before he answered. I saw him do it a few times. It was so funny to me how many times he straight up shook his head and said like, the major drivers of the core PCE inflation, which is what they like to look at, they have that there is no disinflation in them,
yeah,
yet at all. Like their rate hikes haven't even really shown up there yet. And he would just shake his head at these people, and the next person would just ask the same question, like, "So are you going to cut this year?" And he's just like, "Are you guys are obviously not listening to what I'm telling you."
yeah,
Not to mention that they're still shrinking the balance sheet aggressively. So I,
yeah.
I
And
don't know.
here, I found this chart, and I think this says it all. So this orange line, those are the rate hikes historically. The blue line is the S&P 500, and then the gray vertical bars, those are recessions. And look at this. You've got, peak rate hiking cycle. What follows? The recession. It's not spot on. It's not, they didn't announce a rate hike and then you have a recession.
Yeah,
There's a lag effect. Same thing here, goes up, recession follows. So you can look at all these arrows and just notice how the recession follows it. And then look at this, you can see a little clearer what the equities are doing. So, starting in the 80s, had this big rate hike. You had a big crash right there, but we did go on for a pretty big bull market there. But then here, hiked rates again. They both kind of peaked at the same spot. Here's the recession. That was 2001, and look how deep that was.
yep.
2007, same thing. Well, here we are. Here's the stock market. And then here's the Fed just getting started, and they're getting started really fast. I mean, the steepness of this line is something else, but that lag effect, it's going to come. And, I think it's going to come sometime after people stop asking Fed Chair Powell those types of questions. Because
Yeah.
right now they keep, hey, when are you going to get this next rally going? It's like, you guys are not getting it. I mean, there's no pain. Right now, people, it's under the surface, and we're seeing that through credit card balances going up. We're seeing that through repossessions and autos. But the general public right now that is kind of speaking, they're they're not seeing it. And that's the big difference. And I'll tell you, I mean, I'm trying to replace a car right now, and it's still the same problem. I can't find a car right now because they're not really making them. And it's just a weird world out there.
It's everything's so disconnected. It's strange. And I get why the market could keep going up while the Fed's, keeping rates at zero and buying bonds, and like the whole year of 2021, the market should not have been going up out of COVID, right? Like there's no reason for the market to have gone up that much except for that the Fed was easing. Well, now there's no reason for the market to go up the way it's going up, and the Fed is not easing. They're tightening. Now it's just like, what in the world? What is going on out there? Like it just feels to me like the other shoe is gonna drop and just totally crush all the bugs, Like that's what I
Yep.
think. Like we're prepared for now. Who knows? Maybe 6 months from now, I'll look back and say, "Boy, I missed it. I should have been buying stocks hand over fist back then." But I think 6 months from now, we'll look and say, "Wow, we're in the middle of a pretty deep and ugly recession, and I'm glad we didn't, put all of our money in back in January." So
Yep.
anyway, we'll see what happens.
And then Shane, you brought this from Hedgeye, so I'll let you speak to this.
Yeah, I got a few from Hedgeye, and we did a little commercial on those guys last week. So Hedgeye's they put out great data, and I have a tremendous amount of respect for the research that they're doing. Whether you follow their picks or not is a different matter, but the research, it's just math, just numbers, and they've got a great team that puts this stuff out. So, um, what this shows is on the left, the futures market pricing in or expectations for rate hikes going forward. That was before yesterday's announcement, and then on the right side of the chart, you get how it changed after. And you can see that just without getting too carried away into what all the numbers mean, you can see that the rate hike expectations turned into rate cut expectations. Like on the left side, you see all the black bars are just going up, right? They're all above zero. Zero is the bottom of that chart. And then suddenly on the right hand side, using the right axis is the number of hikes priced in. So all of a sudden by October, you get a minus 0.01 rate hike in there. And by November, you get a minus 0.92 rate hikes, which means, that's the market expecting 2 rate cuts by the end of 2023, which going back a couple of slides, Powell literally said it's not happening. Like, we're not doing that. So the market thinks Powell's lying to them. And I think as reality sinks in, the market will cool down. So it's crazy to me that Powell is stuck to what he's been saying, at least since Jackson Hole in August of last year. He hasn't changed his tone, hasn't changed his messaging really at all, and the market just doesn't believe him. Which maybe Fed kind of loses their credibility regularly, so I guess it doesn't totally surprise me that they don't believe him. But if he sticks to it and he continues hiking and doesn't cut at all, this is going to prove to be wrong, and the market is going to come down as a result of those expectations and reality coming into alignment. So,
Yep.
just thought it was interesting how much the market expects him to cut despite everything he said yesterday.
Yeah. And going on that catalyst conversation, I think something that could set off, again, it's not necessarily the Fed hiking rates. Yes, it makes it a more challenging environment, but once you start seeing a company or two where the dead corpses show, so to speak, where they can't find funding anymore and the show's over, those hit headlines, and then it's the oh shoot moment. And I think that could be something that sets it off too. But we still haven't seen that. We're seeing some layoffs, but you know, that I don't think is the indicator in itself. It's always kind of that unknown or surprise event that comes.
Speaking of layoffs, Facebook let go of a whole bunch of people over the past quarter or so, and then announced that they're doing a $40 billion stock buyback. Think about that for a second. Well, you're fired. We're going to use the money we were otherwise going to pay you and just go buy our stock back. That is amazing. And FedEx this morning announced that they were laying off 10% of their executives. So I don't know how many people that really is, but they're going to trim some fat there at FedEx, and I think there's more of that to come.
Yeah. And I think part of that's just we had this easy environment where you didn't really have to prove that you were capable of making money. People were just throwing capital after everything.
Yeah.
And I think there's just a lot of corporate excess that's going to come out. People that find out all they do is sit in a closet and have a stapler they look after, like the movie Office Space. But
Which is signature recessionary bear market behavior. Like it's a signature of that type of environment. So
yep,
again, I just think that fundamentally we're not in a very good space, and there's really no good reason for the market to
nope.
be going up.
And here's the biggest one, the M2 money supply. So we had this huge printing cycle that happened, and this was back when COVID came in. And now, I mean, Shane, am I reading this right? Negative 0.64%, and there's a little red bar right there.
Yep. And we went over this, I
Yeah.
think, in a recent chat because I prepared the charts for it. I was working on my Excel game, and I noticed this, and I was just like, "Wow, that's crazy." So again, they do a better job than me of making charts, so I'm just sharing theirs, giving them full credit though. I did do this last week because the data is available on the St. Louis Fred website, but this is just a better illustration. Like every single bar on the left side is black until until the most recent one for 2022, which is the first year in recorded history where the supply of money went down in a year. Normally, it just goes up. The only question is by how much will it go up? On the right-hand side, you can see that every single one of those boxes is green except for 2022, which is red for the first time ever. So we're in a totally unique spot. Uh, it's unprecedented. Nobody knows what's going to happen, but I'm here to tell you that if you take money out of the economy, that's less money to buy stocks. That's less money to buy products of companies in the S&P 500. That reduces inflation, which is the whole idea. But look, as you bring inflation coming down is great. Being able to afford eggs again will be awesome. I can't wait. I can't wait to buy eggs again because I'm not buying
Yeah.
any right now. But like you have to think of the follow-on effects, right? Inflation coming down means here's a good example. Tesla dropped prices of their cars, right? Like so prices are going to have to come down. When a company drops the price of something that it's selling, what happens to their revenue? It goes down. The whole making it up on volume thing is, it's possible in some situations when the unit economics are good enough and, you have to really increase the number of sales to account for a drop in prices. So it's not impossible to do, but the it has to be just done so perfectly.
Yeah, it's
Most
much different.
commonly, most commonly what happens when you drop prices is revenue goes down. Like that's just it. The reason you're dropping prices is because people can't afford to buy at the price you're selling for,
Hmm.
right? Like so if you just think that through for a moment, earnings are coming down in the market, which is exactly what leads to a recession because GDP is based on people buying stuff from all of those companies. So I mean, to me, this is the main driver, and it's a wild card because we've never seen this before. But we'll see how long the Fed can continue, being tight on monetary policy. As long as the market keeps going up like it's doing right now, they're gonna keep bringing the hikes, no
Yep.
doubt about it.
So, and then here's, inflation and cost of living. A lot of red here. So if you want to talk to this a little bit more, I think this is real average hourly earnings. So Shane, if I understand this correctly, this is saying, if I make go $5 an hour and I get a 3% raise, well, inflation, if it's 7, I'm still negative 4%, right?
You
My
got it.
real earnings has gone down. And that's what we're seeing here. And I'll tell you, when I go to the grocery store, I just can't imagine that equation right now because everything in the grocery store is still sky high. And a lot of people are sitting there, they're not getting real wage increases. They're getting, some nominal ones, but not enough to make up for the cost of what's at the grocery store.
Yeah, I mean, this is just purchasing power. That's what it is. So, if I give you a raise in monopoly money, does that help you? No, it doesn't, because monopoly money doesn't buy you anything, right? So that's essentially what's happening here. I mean, that's an extreme example, but that's it. If they print more dollars and give them to you, it's not going to help you buy more stuff because everybody that you buy it from is just going to raise the price to cover the fact that the dollars got printed. So
Yep.
this is again unprecedented, 19th straight quarters of declining purchasing power. That's basically what this is showing you. And or is that months? Is that months or quarters? Looks like
I think,
quarters. I don't know. It's weird. It's like
yeah,
every
it's
2 months.
every 2 months on there, but I think that if you break it down, it ends up being every month.
Yeah,
Oh,
yeah.
so
Maybe it's months.
interesting stuff. But, here's one. So we keep seeing these analogs and they're popular. History often does rhyme, so it can be close. But Shane, maybe you can talk to this one a little bit.
Well, look, I don't. This isn't. We don't need to spend a lot of time here. Every single one of those red circles represents the bottom of a you know a short-term bottom in the Nasdaq from 2000 through 2002, and the green number represents how much it rallied after that red circle. So you can see that there were, I think it says 11 rallies of more than 10%. Four of them were between 28 and 49%. So you can, you can see the one there that lasted several months and went up 49%. But during that time, the market was down, a lot. A and B notes there are a little off because I think this was prepared, early in January. But Yeah, I was gonna make one of these myself, but it was gonna be it take too much time before this call. And so I figured I'd just throw this one in here to show you guys like, yeah, the market rallied 10% or whatever off its lows. That's not the only time that we've seen that happen, and that doesn't necessarily mean we're in a bull market. I mean, think about it. That 49% rally, how many people out there were saying, "Oh, we're in a new bull market. Market's up 49% off of its lows."
And that
But
almost
you were
lasted a
actually
year.
and you were actually still in a bear market.
Yep.
Think about that. That's kind of wild. So who- it's not like that's unprecedented. That can happen again. We could go up, 30% from the lows in the S&P or the Nasdaq, and we're still going to be in a bear market heading into a recession with the Fed tightening. Look out, man. We can drop a lot more from here. So don't
Yep.
get too excited just because the market's up a bit.
Yep. And then
This one's pretty gnarly. I mean, like this is bad. I know it's a little blurry, and I've posted different versions of this chart, but this one was updated. The ISM data came out yesterday. So non-manufacturing ISM is based on data compiled from purchasing and supply executives nationwide. So they get a survey from the ISM, and they answer questions about business activity and orders and backlogs and all these kinds of things. Basically, what you need to know is that 50 is the line in the sand. Anything below 50 means in decline, and anything above 50 means business is expanding. And you can see that we have like literally crashed from above 65 down to this, I think, like the second or third most negative reading in history on new orders. So this is ugly stat. And again, it doesn't, every time that we drop below 50, there's not a recession that follows, but every recession that we've seen since 82 was preceded by a drop below 50. So again, this just coincides with the yield curve inversion, and I think leads me to believe that we're heading into a gnarly recession with the Fed tightening instead of easing. Like you showed that one chart. Usually the Fed is easing into the recession because they see it coming.
mhm.
They're not easing right now. They're still tightening into what seems like, an imminent recession. So that could make it an uglier recession than normal, in my opinion.
I agree. And here's a perfect illustration. And, again, from Hedgeye, they have a great illustrator over there that does these. But you can see the rockets blowing up, and yeah, I don't, doesn't take too much explaining here.
No, it's just a funny cartoon. Uh, Yeah, and the soft landing, to be clear, is that the Fed can tackle inflation, get inflation back to 2%, without causing a recession. That's what a soft landing is. And
Yeah.
you might as well just draw a picture of a unicorn, because I don't think it's possible.
Well,
I
it's
Maybe it's
Shane,
possible. It's definitely not likely.
can you name a time where they've had a soft landing?
No.
I mean, that's kind of the thing that just gets me every time is this time is different. You
Oh
know,
yeah.
hey, forget about that broken past. We're getting it right this time. And
Yeah,
it's,
this time it's different is like almost as dangerous as I missed it, which you and I talked about yesterday.
yep,
Stupid charts that we both have missed lately, and didn't buy the rallies because it's just too hard to believe that they'll keep going up.
yep. And the last thing you ever want to do is buy on hopes and dreams. You don't
Yeah.
want to go in thinking that, well, this time they're going to get it right and there's this huge upside baked in. That's not the case. Just manage the risk, pay attention to what's going on out there.
Hope
So,
is not a strategy, man.
no, but if you do want to make a lot of money though, chickens, that's where it's at. So, with eggs going up the way they have, those things produce eggs every day and they just kind of peck things off the ground. I think
Man, the
that's
Babylon Bee is so funny. And like I have a habit of just like reading their headlines and laughing, but like every now and then I'll actually click on it and read the article, the whole satire article, and it's like the way they write is just funny. Like so I'm gonna read this just because it's hilarious to me. So with egg prices soaring to historic highs, multi-billionaire Elon Musk has been dethroned as the world's richest after local farmer Old Man Hopkins reported that his New Hampshire Red, who he had named Hen, had surpassed Musk in net worth. The punchline is right there. Bok bok, says the Hen in response. So, if you can go long bok bok futures, that's what I would be doing.
yeah.
My goodness.
So
Eggs are so expensive. I wish
are.
somebody would have asked Powell, hey, Jerry, where do you buy your eggs? I'm asking for a friend. Anyway, yeah, so I'm in total disbelief. This week is a perfect example of why, you don't go all in on anything, even if you think you're super smart and have a good understanding of what's going to happen. The market can easily go the opposite way and wipe you out quickly. Like if you're short the wrong stuff and you refuse to follow your stops and manage your risk and get out, um, or if you refuse to take some longs when the charts are telling you it's time to go long, despite all of the economics lining up on the other side. Um, you know, I hate all of the longs in my account. I told you guys last week when we were in Miami, I got no shorts in the account. I had nothing but longs in the account, and it still today. I did try to short a couple things yesterday, and I stopped out of them already. So um, that's the nature of the beast, man. Sometimes it's just frustrating. I've been frustrated all year. My personal account, my trading account is down this year after being up last year, and it's just so annoying.
Yeah,
But anyway, this too shall pass, and I'll get back on the right side of it eventually.
sounds good. Well, good luck with that, and we'll see what the week brings, and we'll see everyone again next Thursday. So thanks again for tuning in.
Thanks, Kyle. Later, buddy.
Have a good one.